Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes, and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. All right, so today we're doing a deep dive into a company called Unimech Aerospace and Manufacturing Limited.
Yes, and we're zeroing in on a really classic inflection point for a company, the post-IPO structural break.
Exactly. Our mission here is to really unpack what's driving their performance after they got this huge injection of cash. It's a trade-off, isn't it? This massive growth potential they've bought versus, their immediate capital efficiency.
It's such a fascinating story. I mean, on one hand, you have a company with these incredible industry-leading margins. It suggests they have this powerful moat.
Almost impenetrable. But then you look at the financials right after the IPO, and you see these huge red flags popping up. Asset utilization, debt coverage. It's all a bit concerning.
It really is. We're basically watching a very successful small company try to absorb and deploy an immense amount of capital, almost overnight.
It's like trying to drink from a fire hose.
Yeah.
So for everyone listening, here's the plan. We'll start with the sector tailwinds, why this space is so attractive.
Then we'll get into the messy part, those dramatic financial shifts, the efficiency crisis.
Right. And then we'll try to understand why the market is still giving it such a premium valuation despite these issues, and critically, what risks you need to keep an eye on.
Sounds like a plan.
Okay, let's set the stage, the macro view. Why is aerospace and defense, especially in India, so hot right now?
Well, it's really built on some very durable long-term trends. You have the domestic story, where the Indian government is pushing hard for what they call indigenization.
Local manufacturing, basically.
Exactly. And it's not just talk. They've earmarked 75% of the entire modernization budget for domestic procurement. That's a massive structural support for demand.
A huge floor under the market. And what about the global picture?
That's the other side of it. Global aircraft order backlogs are, well, they're at all-time highs.
So you're talking Boeing, Airbus.
Right. And when their order books are full for years to come, that demand trickles down. It creates the sustained long-term need for maintenance, repair, and overhaul MRO tooling, and for precision parts.
Which is Unimech's exact sweet spot.
It is. That's their competitive edge. They are perfectly positioned in that high-margin aero tooling niche. I think it was something like 3/4 of their revenue last fiscal year.
So what makes their moat so strong? Why can't others just jump in?
It's the barriers to entry. They are just incredibly high, and they take years to overcome. This isn't simple manufacturing. To supply a company like Boeing, you need to go through these multi-year qualification cycles. You need specialized aeronautical expertise, certifications. You can't just spin that up in a few months.
And you can see that moat in the numbers.
Oh, absolutely. That's where it shines. Their profitability is just exceptional. We're talking about a consolidated gross margin that's hovering right around 70%.
69.37 to be exact.
And a net margin over 34%. Margins like that just scream pricing power. They tell you there is very little real competition in their specific niche.
And their customer list. It's a who's who. Boeing, Airbus. I saw they're a green channel partner. What does that mean for you, the learner?
Being a green channel partner is a huge signal of trust. It basically means fewer logistical headaches like customs checks. It gives them an operational speed advantage that their competitors just don't have.
So fantastic business, great moat. Which brings us to the big question. What happened when all that IPO cash hit their bank account? Let's talk about that structural bug in FY25.
Well, the immediate impact was contradictory.
How so?
On the surface, the balance sheet looks amazing. They paid down debt, so their debt-to-equity ratio dropped from 0.27x all the way down to just 0.11x. They're flush with cash.
That's the good news.
But the friction starts with the sheer scale of everything. Revenue growth was still positive, about 16%, but that's a huge slowdown from the 120% growth they had the year before.
And at the same time, their assets just exploded.
Exploded is the right word. Total assets grew by a shocking 336% in a single year.
Wow. And that's the core of this efficiency crisis, isn't it?
Right.
All that money poured into new factories, new equipment, what accountants call PPE and CWA.
Precisely. The capital has been deployed, but it's just sitting there. It's dormant, waiting for those new facilities to actually come online and start producing something.
And you see this delay immediately in the efficiency metrics. Let's talk about ROCE, return on capital employed. For anyone new to this, it's a key measure of how well a company is turning its money into profit.
And their ROCE used to be incredible. I mean, it peaked at an eye-watering 76.5%.
Then after the IPO,
It plunged down to 34.5%. That is a massive drop. It tells you that all this new capital is not even close to pulling its own weight yet.
the asset turnover ratio tells the same story, just starker.
Yeah.
That number basically asks how much revenue you generate for every dollar of assets you own.
And that ratio just fell off a cliff. It went from 2.25x all the way down to 0.35x.
So for every dollar in assets, they're now generating only 35 cents in revenue.
It's a huge drop. It confirms that the capital is just tied up in unused capacity, and we know their current capacity utilization is only sitting at about 55%.
Okay, so this inefficiency creates immediate risks. Let's talk about the two metrics that really raise some alarms for the near term.
The biggest one, the most critical, is the debt servicing coverage ratio, or DSCR.
And that measures.
It measures the company's ability to use its operating cash flow, the cash from its actual business, to cover its scheduled debt payments, both the interest and the principal.
And that number is
It's precarious. It declined to 0.20x.
0.2.
Yes, down from 0.74x the year before. Anything below 1 is a red flag. A DSCR of 0.20x means their operating cash flow is nowhere near enough to cover their debt payments.
So they have to use the IPO cash pile to pay their debts.
They have no choice. It's a total operational mismatch. They're funding debt service with their savings account, not their salary.
That is a huge warning sign. And beyond the debt, there's a problem with earnings quality too, right? Especially if you strip out the subsidiary and just look at the standalone company.
Yes. If you look at the standalone results, you see something called other income surged by over 850%.
And that's not from selling their products.
Not at all. It's almost entirely interest income and gains they made from parking all that IPO cash in short-term financial instruments.
So they're making money from their money, not their business.
And here's the kicker. That non-core income made up over 112% of their standalone net profit.
Wait, over 100%.
Yes. Which means if you take away that interest income, the core operating business at the standalone level was actually losing money. The only reason they posted a profit was because of the interest on their cash pile.
So that inflates the profitability picture significantly. Okay, let's pivot. The company is dealing with these internal issues, but what about external risks?
Well, their export exposure is very high, around 89% of revenue.
Which makes them vulnerable to.
Geopolitics, specifically tariff uncertainty from the U.S., which has already caused some sales slowdowns and order delays.
And how are they trying to mitigate that?
They have a strategic diversification plan. They're pushing into the nuclear and high-precision segments, and they're targeting a 35% revenue mix from those areas by fiscal 29.
Are they making progress?
It seems so. They have a huge pipeline in the nuclear sector. Over 800 cores, which is about 96 million US dollars in submitted bids. That could be a massive long-term order book.
But that diversification creates its own new risk, right? A working capital strain.
It does. The nuclear segment has very long lead times and, let's say, bureaucratic payment schedules. This is going to increase their cash conversion cycle, the time it takes to get paid.
For what to what?
It's projected to go from a very efficient 100 days right now up to 150 or 160 days. That difference is going to tie up a lot more cash in the future.
Okay, so connecting all these dots, the market seems to be completely ignoring these issues because the stock is trading at a massive premium.
A huge premium. The trailing PE ratio is somewhere between 59 and 65 times, and the EV to EBITDA is nearly 40 times.
That's just wild. You compare that to a peer like Dynamatic Technologies, their PE is closer to 25, EBITDA is around 10 or 12. How does the market justify paying 4 times as much?
It's all about looking forward. In a business like this, which is so capital intensive, EV to EBITDA is probably the most relevant metric right now.
Why is that?
Because that massive spending on new factories caused their depreciation, a non-cash expense, to jump by over 136%. EBITDA smooths that out, it normalizes for it.
So the market is looking past the current mess.
Completely. The high multiple reflects the market's conviction that the company is going to pull this off, that they'll achieve huge operating leverage once those new assets are fully utilized. Investors are paying today for the profits they expect in 2028 or 2029.
They're paying for future perfection. So what are the key catalysts they have to hit to actually earn that valuation?
Two things, really. First and most important is capacity realization.
Getting that utilization number up.
Way up. They have to get from that abysmal 55% today to their target of 85 or 90% by FY29. If they do that, they can hit their 1,000 crore revenue goal. That is the number one lever.
And number two.
Nuclear conversion. They have to turn that 800 crore pipeline of bids into actual signed contracts. The market needs to see that for long-term visibility.
Okay, so for you, the learner who wants to track their execution, what are the 3 critical KPIs to watch every quarter?
You need to watch the metrics that show if the assets are working and what their funding needs are.
So KPI number 1.
Asset turnover ratio, no question. It has to show consistent, rapid improvement from that low of 0.35x back towards their peak target of 3 to 3.5 times. If that number isn't climbing steadily, the whole story falls apart.
Makes sense. And KPI number 2 must be related to the diversification strategy.
The cash conversion cycle, the CCC. You need to watch for that projected increase to 150 or 160 days. That number will tell you the real cost of doing business in the nuclear sector.
Yeah, the last one.
The order book-to-bill ratio. Right now, it's pretty low, only about 0.43 times their annual revenue. They have to convert those big nuclear bids to get that number up and give the market confidence in their growth story.
So let's synthesize this. What's the final analyst opinion here?
I mean, look, Unimech has a fantastic, durable moat. You can see it in their margins. And they have exceptional liquidity after the IPO. That's the good news.
Yep.
But the structural dilution of their capital efficiency, that ROCE dropping to 34%, and that critical debt service mismatch, the BEO 0.20x ME/DSCR, those are severe short-term problems.
So it's a race.
It's an operational race against the clock. Their success hinges entirely on transitioning from asset accumulation to aggressive revenue realization. They have maybe 24 to 30 months to prove they can do it.
A race against the clock indeed. And that leaves us with a final provocative thought for you to chew on. We've established that the company has to use its IPO cash pile, not its operating cash, to pay its debts. And it's also using the interest from that cash to make its standalone profits look better than they are. So given this double reliance on the IPO cash, what is the true hidden cost of having all that liquidity just sitting in financial instruments? And more importantly, what is the maximum time window before the market stops being patient, stops forgiving the low asset utilization, and demands to see real operational returns? Something to think about. Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time. Welcome to Analyst's Estimate. We bridge the